morning. It's great that I've been given the opportunity to talk to you all today about all things self-employed. So I'm going to spend the next 20 minutes or so talking about how lenders across the industry support our self-employed mortgage customers and the challenges they face. So I'm Jane Faulkner and I'm head of the Central and South West region for Intermediaries at HSBC. So on the agenda is post-COVID-19. So how are lenders managing since March last year? A bit of history about MMR and how this has affected self-employed lending. Self-employed v employed, income assessment and the differences in documentation required by lenders. The government schemes, the types of and how they have helped. And the importance of future-proofing for ease and speed of processing with open banking. And then I'll open up with any questions. So I'll start with a quote I particularly like from the past 12 months. Be fast, have no regrets. If you need to be right before you move, you will never win, said Mike Ryan, an epidemiologist at the World Health Organization in March last year. So how can we in the mortgage industry relate to this? Well, 2020 was a year when we all had to change very rapidly from March the 23rd if we were to continue to grow the mortgage business. And every lender, advisor and customer had to adapt to a new way of working to ensure the mortgage industry's wheels kept on turning. Some lenders adapted quicker than others, and HSBC in particular did a fabulous job of enabling all of our mortgage colleagues, whether they be answering the phones to our brokers, underwriting applications, or developing business with our existing networks. You might think, of course, you'd say that, but I do genuinely think that this is the case. And feedback we've received from brokers backs that up. The quote mentions be fast, and we certainly were, with everybody up and running within weeks to ensure a smooth transition of service to our customers. And we definitely do not have any regrets. Even being the only lender to stay in the 90% LTV space for most of the summer, this enabled us to ensure we were there for our customers no matter what. It came with its challenges around service, but allowed us to grow even stronger as a brand with fantastic feedback from our networks about how resilient we were, whilst other key lenders could not or chose not to remain in this space. So on to our self-employed customers. A survey carried out last year by Studio Graphene on 1,200 people aged 18 to 55 discovered that 8% of respondents had started a business of their own recently, and 10% planned to do so, with 40% of this cohort motivated to do so by being placed on furlough or having been made redundant. So definitely a growing market. So let's go through a bit of history around self-employed customers where lending is increasing, but at a significantly lower level than pre-crisis back in 2008. So back in 2006, around 17% of all mortgage sales were to self-employed borrowers, whereas today that figure stands at 11%, with around 15% or 5 million of the UK working population being self-employed. This follows a sharp decline post-crisis from 2008 to 2012, and while there has been a gradual rise since then, today the number of sales is still only about a third of those in 2006. A major cause of this was the decline of self-certified mortgages. These were mainly sold by specialist lenders, primarily non-banks, and were withdrawn post-crisis as many of these firms exited the market. There were also significant question marks over their efficacy and accuracy. Regulatory requirements for all mortgages to be income verified have mitigated against the re-emergence of self-certified products. So let's have a look at some regional statistics comparing employed and self-employed mortgages across the industry. So the 11% that I alluded to, very similar across the UK, ranging from 8% in Scotland and the North East, up to 12% in London and the South. The remaining split of data is made up of retired and unknown employment status. So not really a huge difference across the UK. And if we look at HSBC UK split for applications last year, we can see that we've been incredibly supportive of our self-employed customers, as we're actually higher than the industry average, proving that we are dedicated to helping and supporting this population. FCA rules require firms to verify income as part of the affordability assessment. Although the rules do not differentiate between verifying the income of employed or self-employed borrowers, there were concerns raised at the time of implementation that the self-employed may find it more difficult to provide suitable evidence of earnings. The data shows that the proportion of customers taking out a mortgage who are self-employed has remained broadly unchanged, as I've previously mentioned. So let's look at the difference between evidencing income for employed and self-employed. So for employed, some firms' lending policies require only one payslip as evidence of a customer's income. And while this may be representative where the customer's income is consistent, the FCA did see examples where it was relied on in relation to variable pay as well. Using one payslip captures earnings at a specific point in time. If used in isolation, lenders need to satisfy themselves that they have considered income over an adequate period to assess affordability. Now, most lenders had clearly laid out policies on how they assess self-employed earnings. The responsible lending requirements do not specify the period of time over which a lender must assess self-employed earnings, which is reflected by the differences found in the policies the FCA reviewed. Assessing self-employed earnings can be more complex than employed earnings. So when assessing their income, lenders sampled typically reviewed the last 2 or 3 years of earnings. The complexity of some self-employed earnings presented challenges for firms. In assessing these earnings, firms either reviewed business accounts or self-assessment returns that have been accepted by the Inland Revenue, such as SA 302s. Due to the more volatile nature of self-employed earnings, there are often large differences in individual customers' annual earnings. The FCA found that lenders often averaged amounts across these periods to provide a more moderated assessment of income. Lenders often use a combination of SA 302s and business accounts as evidence of earnings, as they appear to have recognised the risk of using SA 302s in isolation. These documents alone may not always be an accurate reflection of earnings, as documents can be amended and reproduced at a later date. If we look at post-COVID lending, some lenders will now request a business bank statement pre-COVID and the last 60 days of bank accounts, along with the last 2 years signed accounts. So as a broker, it is really important to ask if their business has been impacted to ascertain the risk. The blanket approach taken by lenders early on in the pandemic to underwrite a self-employed case has now changed, as lenders realise that some business haven't been affected by COVID at all. So why is it more difficult post-pandemic to get a mortgage if you are self-employed? Well, Prospect launched a new inquiry into the future of self-employed in February of this year, alongside Community, which brings together unions, politicians and policy experts to find some solutions to the big challenges faced, like how to provide a proper safety net for the self-employed, how to make sure that the government understands self-employment, and how to make sure the benefits self-employed people receive are fair compared to their taxes. So let's have a look at some of the key findings. 46% said that they were less likely to continue in self-employment due to their experience in the pandemic. 88% said that the level of pandemic support for the self-employed was not a fair reflection of their tax contribution. 79% would oppose the equalisation of national insurance contributions between employees and the self-employed. Yet 51% would support paying more out of their wages in exchange for a stronger safety net. And 75% do not believe they have sufficient workplace rights compared to employees. Now, the report argues that self-employed workers in the UK face too much risk and that action is needed to tip the scales back in the direction of additional security and protection. The inquiry found that self-employed workers had been hit incredibly hard by the pandemic, and as a result, many were considering leaving their businesses in the future. The pandemic had exposed to many the financial insecurity of self-employment and had fostered a desire for additional protections and safeguards to stabilise the position of the self-employed in the future. The inquiry also argues that additional financial support is necessary to enable a swift economic recovery in 2021, and that failure to offer this support will cause long-term economic damage by destroying small businesses and driving people out of self-employment. With the vaccine offering hope of a return to normality quickly, the cost of a few months of extra support must be weighed against the likely damage caused if no action is taken. Now, the pandemic has caused two big issues for lenders. They've needed to reduce their risk at a time of economic uncertainty, and they've struggled to keep up with the demand from applicants and queries from existing customers. This has led to some lenders putting limits on their mortgage deals, and self-employed borrowers are among those worst affected, as almost all cases are being referred to manual underwriting, which typically takes longer to approve. So as well as setting strict limits on how much self-employed people can borrow, banks are also increasing the amount of diligence they undertake before signing off on loans, meaning that the process can be more complicated and take much longer than before. I think we can all agree that lending beyond someone's means is not appropriate and in nobody's best interests. Another common question asked since the government introduced the Self-Employed Income Support Scheme and the Bounce Back Loan Scheme is how will this affect affordability? So some background on the government schemes. The government has announced many financial support initiatives for businesses impacted by the coronavirus outbreak, including business loan schemes, job retention scheme, the Self-Employment Income Support Scheme, Eat Out to Help Out, and business rates relief and grants. Now, the Coronavirus Job Retention Scheme received 9.6 million applications as of October 2020, whereas the Self-Employment Income Support Scheme received 2.3 million claims. And it was just announced in the budget that these schemes will be extended until September. The government confirmed that the fourth CES grant will be worth 80% of 3 months' average trading profits paid out in a single instalment and capped at £7,500. They also announced that there will be a fifth and final CES grant covering May to September. People whose turnover has fallen by 30% or more will continue to receive the full grant worth 80% of 3 months' average trading profits capped at £7,500. And people whose turnover has fallen by less than 30% will receive a 30% grant capped at £2,850. The final grant can be claimed from late July. Over 600,000 individuals may be newly eligible for CES, including many new to self-employment in 2019 and 2020. So back to some stats. By the 30th of September, HMRC had received 1.6 million claims from men, totalling 4.4 billion, compared to 655,000 claims from women for 1.3 billion. And perhaps reflecting their relative size, the two regions with the highest number of claims are London and the South East. As the application end date passed for the second CES grant, HMRC found that just 67% of the potentially eligible population had claimed, with the average value per claim at £2,500. That means that a whopping 33% neglected to claim, perhaps because they didn't know they were eligible, they'd missed the date, or even thought it may impact their borrowing capability going forward. So how do these government loans affect affordability for our self-employed customers? There have been many news headlines stating things such as leading UK banks are refusing to provide mortgages to self-employed workers if they took COVID loans or income grants, despite being told by the government and banking watchdog that the payments would not affect their credit ratings. More hoops, more scrutiny, less money. Are lenders taking sensible precautions, or is it a case of short-sightedness? Whereas in reality, lenders are now referring applications from the self-employed to their manual underwriters automatically, whether they had received financial support from government COVID schemes or not. And the FCA state that making use of one of the government financial support schemes should not prevent self-employed people from accessing credit. Each lender is different with a different appetite. Some lenders reduce the LTV limits, whereas others will ignore debts being cleared for employed borrowers when assessing affordability, but will still factor them in when assessing affordability for the self-employed. Brokers believe that lenders are applying more forensic underwriting for the self-employed by requesting sight of multiple months' worth of business bank statements, along with commentaries regarding their future trading and whether this is sustainable. A tip for your customers to ensure a speedy process is to get all the relevant documentation prior to submission, including personal and business bank statements as required by the lender. And as the new tax returns are imminent, it's highly probable that the self-employed income assessment criteria will be reviewed by all lenders as we get a more accurate picture of that business's trading. Another thing that will definitely speed up the application processing times for both the lenders and the brokers is open banking, which HSBC were the first lender to launch to our self-employed customers on the 8th of March. So a bit of background. Since credit policy was updated for COVID-19, self-employed customers have had to provide us with business bank statements from January, February or March 2020 and their most recent 60 calendar days. This has increased customer and broker effort in packaging an application to us. This requirement and the rules around it have often led to errors with the initial submission and meant we've had to go back and ask for more before an assessment can be completed. When the case is ready for review, the underwriting process is very time consuming and is regularly taking in excess of 2 hours. This not only impacts the self-employed customers, but also has a knock-on effect on all applications awaiting assessment. So open banking provides the customers with a digital platform for supplying business bank statements, presenting them with a quicker and easier way to share statement data to support their application. We've partnered with Experian, allowing customers to share transaction data with us in a matter of minutes. Customers will provide a one-off consent for Experian to access their business account data and share with us for use in our assessment. As long as their bank is subscribed to the scheme and they have access to manage their account online, then the process is available. Experian will then categorise up to 3 years' worth of transaction data and make it available to us for underwriting to use as part of their assessment. However, despite access up to 3 years' commercial bank statements, HSBC will be applying the same underwriting logic to open banking as they do with commercial statements, i.e., open banking is going to provide the transaction data we require for a month prior to COVID and the last 60 days. This will halve the underwriting time and allow HSBC to continue to support the self-employed market and potentially lend more across all product lines. From an advisor point of view, the customer is presented with the 3 years data in a PDF file on completion of the open banking access, which can be stored on your file to satisfy your compliance requirements. It's absolutely vital that we all embrace this new technology as it clearly signposts the future of self-employed underwriting. And as an added incentive, HSBC will prioritise those self-employed applications that use open banking to demonstrate affordability. However, we do appreciate that not everybody has access to online banking, and the Experian open banking product does have some absent commercial banks. To combat the increase in underwriting times, we have developed some in-house software that will partially automate the underwriting assessment by screen scraping data from a customer's commercial bank statements, distinguishing between different transactions and providing the requisite summary back to an underwriter, saving up to 50% again of underwriting time. This same software works for PDF statement uploads from Lloyds, NatWest, Santander and Barclays, as long as they are in the same format when they get to us than they were when they were first downloaded. So in summary, lenders are definitely here to do mortgage business with our self-employed customers and are working within credit policy guidelines to enable the overall process to be efficient for both our brokers and our customers. Data has proved that self-employed customers are incredibly resilient. Delinquency rates historically have been low. Their borrowing power can be increased as they are more cautious. They are hugely important to the economy and the housing and mortgage markets and have more excess affordability than employed customers. We need to embrace the new technology with open banking to future-proof for speed and ease. And of course, BDMs and help desks are there to support you whenever you have any questions. So now I'd like to open it up to any questions. Thank you.